You think the 1% pays the same tax rates you do and just has more money left over. That is the assumption, and it is wrong in a specific, structural, documented way that changes everything about how generational wealth actually works in this country. Here is where we are right now. A family with $40 million in appreciated assets can pass every single dollar of that to their children, and the children owe zero capital gains tax on decades of accumulated growth. Not reduced, not deferred. Zero. It is called the stepped-up basis. It is written directly into the Internal Revenue Code. It is not a loophole in the hiding money offshore sense of the word. It is not illegal. It is architecture. And it has been architecture for long enough that entire generations of wealth have been built around it without most people ever learning it by name. The reason you have never heard it explained clearly is not because it is secret. It is because the people who benefit from it have no reason to explain it to you. And the people who do not benefit from it were never in the room when it was designed. That is where we are starting. In the middle of the mechanism. Because the mechanism is already running. For some people, for some families, in some zip codes. And it has been running for generations. Watch what happens when we follow the evidence backward. If you want to understand how this structure works from the inside, not the talking points version, not the outrage version, but the actual mechanics of how it compounds across time and across generations. Subscribe now, because what follows is not a political argument. It is an investigation, and the evidence, when you lay it out carefully, does not fit neatly on either side of the conversation most people are having about this. Here is the first piece of evidence. The stepped-up basis works like this. You buy stock in 1980 at $10 a share. Over 40 years, that stock grows to $500 a share. On paper, you have a gain of $490 per share. Under normal rules, the rules that apply when you sell during your lifetime, you would owe capital gains tax on that $490. Long-term rate, federal, possibly state on top. That is real money, leaving the position. But if you die holding those shares and pass them to your children, the cost basis resets to the current fair market value, $500. The gain that existed for 40 years is erased, not taxed, not deferred until later. Erased. Your children can sell the next morning and owe nothing on 4 decades of appreciation. Think about what that sentence means in practice. A gain that existed for 40 years. Gone. Now, before we go further, I want to say something that might sound counterintuitive. This is not a video about whether that policy is fair. That debate exists, and smart, informed people land on different sides of it, depending on what they think the tax code should incentivize. This is a video about understanding a structure that operates whether you think it is fair or not. Because if you do not understand how it operates, you cannot make decisions that account for its existence. And it does exist. Right now. Today. Before my first 100,000, I thought wealthy families stayed wealthy because they simply earned more than they spent over a long enough period of time. And that is part of it. But it is not the mechanism. The mechanism is that they understand which rules apply to which assets at which moments, and they build their financial structure around those rules years before the moment arrives when the rules matter most. Here's what nobody tells you about the stepped-up basis specifically. It does not work the same way for everyone, and the difference between who benefits from it and who does not is not income level. It is asset class and holding period. The rule applies to long-term appreciated assets held until death. Stocks, real estate, private business ownership, interests in partnerships, assets that grow in value over time and are not liquidated. What it does not help with, and this is the part most financial coverage skips because it complicates the framing, is earned income, a salary, a year-end bonus, a distribution from a business you actively manage and pay yourself from. Those get taxed as ordinary income regardless of how much you have accumulated and regardless of how long you have been earning. The rule of this level is this: the tax code does not distinguish between rich and poor. It distinguishes between earners and owners. Earners pay taxes on everything they make in the year they make it. Owners pay taxes based on when and how they choose to realize gains. And sometimes, with the right structure and the right holding period and the right timing, they can choose never to realize them at all. So, if you are optimizing your financial life entirely around earning more, climbing to the next title, growing the salary, expanding revenue, you are operating inside one set of rules. A real set of rules with real advantages that compound over time. And if you are building toward ownership, accumulating assets that appreciate, structuring how they are held, thinking about how they transfer, you are operating inside a different set of rules entirely. Both sets are legal. Both sets are written down in documents that are publicly accessible. One of them is taught in schools. The other one you find out about when you are already in the room. Here is what that looks like across 2 lifetimes. A high-income earner makes $300,000 a year for 20 years. They save consistently. They invest well. At the end of those 20 years, they have built significant net worth, but most of it lives inside a taxable brokerage account that has been appreciating steadily. When they die and pass those holdings to their children, the stepped-up basis erases every dollar of growth that happened inside that account. Everything that compounded over 20 years resets to zero for tax purposes at the moment of transfer. Now, a person who earns $60,000 a year but buys a duplex in their 20s, rents it, holds it through every bad year and every good year without selling, and passes it to their kids at death, the same mechanism applies. The asset is different. The scale is different. The income that funded the purchase was different. The principle is identical. The structure does not care how much you make. It cares about what you own and how long you hold it. Here's the thing, though. And this is what took me the longest to actually see. Most people are optimizing for income because income is what gets measured. It shows up on your W-2. It determines your mortgage eligibility. It is what people ask about indirectly at dinner parties, through the zip code you live in and the car you drive. But income, by itself, is the most taxed and the least protected form of money you can have. The stepped-up basis does not help earned income at all. Not $1. Every salary you earn in your life gets taxed the year you earn it, at ordinary income rates, with no reset mechanism waiting on the other side. But wait, here is where it gets interesting. And this is the part that most explanations leave out because it genuinely complicates the narrative that everyone wants to tell about this topic. The stepped-up basis is not a policy that only the ultra-wealthy can access. It is a policy that rewards a specific set of behaviors: long-term ownership, low turnover, holding through volatility, intergenerational thinking, behaviors that are available at every income level, but are structurally harder to maintain when you are starting with fewer resources. Think about what it actually takes to hold an asset for 40 years without selling. You need enough income from other sources to cover your living expenses without touching the position. You need enough financial stability that a single bad year, a medical bill, a job loss, a car that dies the same week the furnace goes, does not force you to liquidate. You need enough knowledge to hold steady during market downturns when every signal around you says to sell. And you need a legal and financial structure that handles the transfer correctly when the time comes. None of those requirements are expensive on their own, but all of them are easier to meet when you already have a margin of safety. And that, right there, is the architecture. Not a conspiracy. Not a deliberate design to keep anyone in a specific place. A structure that rewards behaviors which compound more easily when you start from a position of stability. The gap between understanding the rule and being able to execute the rule is not always about intelligence. Sometimes it is entirely about the distance between your current income and your current expenses. I want to be careful here, because this is the point where this conversation usually goes somewhere I think is less useful. You can look at this structure and conclude it is inequitable and should be reformed. You can look at it and conclude it is a reasonable incentive for long-term capital formation. Those are legitimate positions, and smart people hold both of them. What I will not let either conclusion do is prevent you from understanding how the mechanism works. Because the mechanism works regardless of how you feel about it. You are already living inside this structure. The only question is whether you are building on its terms or simply experiencing it as something that happens to other people. And I know how that sounds. It sounds like I am telling you to play a game you did not design and do not control. But look, you did not design the rules of gravity either. You still work with them every time you take a step. The architecture of the tax code is no different. It exists. It has consequences. Understanding it does not mean endorsing it. It means not being surprised by it 20 years from now when you realize you could have built something different. Back to where we started. $40 million. Zero capital gains. Children who inherit not just the assets, but the reset basis and the structure that built around them. The thing I want you to take from this is not outrage and not a how-to guide for replicating it at a specific scale. What I want you to take is the frame. The understanding that the tax code has architecture, that the architecture rewards specific behaviors, and that those behaviors, long-term ownership, low turnover, assets that appreciate over time, decisions made years before they matter, are accessible at levels well below 40 million. A Roth IRA opened at 22 and never touched until retirement grows entirely tax-free and passes to your beneficiaries in a specific, structured way. That is the same principle at a much smaller scale. An index fund position held for 30 years instead of traded quarterly. Same principle. A property bought, rented, held, and passed instead of sold at the first sign of appreciation. Same principle. The scale is different. The mechanism is not. What the families who stay wealthy figured out, or inherited the knowledge of from the generation before them, is not a secret being actively guarded. It is a framework for thinking about assets over time instead of income over months. The mindset that asks not just how much can I earn this year, but what am I building that will still be worth something in 30 years when I am not here to manage it daily. You do not need $40 million to start thinking inside that framework. You need to understand that earning more is not the same as building more, that the rules are different depending on whether you are earning or owning, and that the distance between where you are and the kind of wealth that persists across generations is not always a matter of income. Sometimes, often, it is a matter of structure. The ceiling was always there. Now you know where it is. This is not financial advice. It is a story about decisions, the kind that compound, the kind that do not, and the kind you make before you understand which one you are making.